So, you're thinking about buying your first home. You're probably feeling a little overwhelmed. Everyone has advice for you. Your uncle who bought 30 years ago, your buddy who bought 4 years ago, but today it's a different world. So in this video, I'm going to walk you through everything that you need to know step by step in a really simple, easy way. The first thing you need to know is there are some tools out there that can help you get started. Smart tools to help you save and invest when you're first starting out. The first I'd recommend is the First Home Savings Account, or the FHSA. If you're a first-time home buyer, you can put away up to $8,000 a year and up to $40,000 total. And the best part is when you contribute this money, your taxable income is going to be lowered, so you can pay less tax at the end of the year. What I mean by that is let's say you made $70,000 a year, and in that same year, you contributed $8,000 to your First Home Savings Account. The government will treat it like you only made $62,000 a year and you pay less tax that year. What's even better is the money inside of this account can be invested. So you can hold things like individual stocks, ETFs, index funds, or even high interest savings, all of which are going to depend on your own comfort level. And when you use the money to buy your first home, you don't pay any tax on it. So it's like the best part of the RRSP and the TFSA combined, but made just for first-time homebuyers. You also have the RRSP Home Buyers Plan, which is another way to help you with your down payment. Now, an RRSP is a retirement account that's designed to help you grow your money while paying less tax. But with the Home Buyers Plan, the government will allow you to borrow up to $60,000 from your RRSP, tax-free, to help you buy your first home. Also, if you're buying with a partner, you can each use your RRSPs up for a total of $120,000. Now, you do have to pay that money back over the next 15 years. But if you've already been contributing to your RRSP, this can give your down payment a major boost without needing to save all that money from scratch. Also, let's not forget about your TFSA, your tax-free savings account, but treat it very, very carefully. Your TFSA is your future freedom fund. It's not just a piggy bank for today. So if you've been investing inside of it, pulling money out can quietly cost you way more over time because you're losing years of tax-free growth. And even though technically you get that contribution room back the next year, what you can't replace is the time that you've lost. Because it may be cringe, but every smart dollar you leave invested today is going to buy you options. It's going to buy you freedom for tomorrow. Now, what does it actually take to buy a home? Well, in Canada, it's pretty simple. Down payment rules are pretty simple. 5% on the first $500,000, 10% on anything between $500,000 and $1 million. So if you're buying a $750,000 home, your minimum down payment would be about $50,000. But if you put less than 20% down, there's a catch. You'll have to pay something called mortgage insurance. This insurance is designed to protect the lender, not you. Protect the lender in case you ever stop making payments. And typically, it's added right on top of your mortgage, so you don't have to pay for it separately up front. It's easy to think about it like this. It's the price that you paid to get into the market sooner without having to save or pay a full 20% down. A lot of people think that once you have your mortgage, you're done. And that's not exactly true. The real costs of owning a home are your monthly mortgage payment, your property taxes, your home insurance, regular maintenance, and repairs, because shit breaks. So on a $750,000 home, you might be looking at anywhere between $4,600 to $4,700 a month. It's not just your mortgage, it's the full picture. Before you start seriously looking, I urge you to get pre-approved. And you can think about it like this. Think about it like booking a flight. You need a ticket to board the plane. Your pre-approval is going to give you clarity on how much you can afford, what your payments will look like, and what you should actually be shopping for. It's free. and it's going to save you a ton of stress down the line. Another thing is, when you're getting your mortgage, one of the biggest choices you'll make is either a fixed rate or a variable rate. Here's the quick breakdown. A fixed rate is going to give you peace of mind. You lock in a specific rate and you know exactly what your payment will be every single month. Whereas a variable rate, you can save money over the long run, but your payment can move up or it can move down with the market. So if interest rates go up, your payment could go up. If interest rates go down, you could save money. One other thing most people don't realize is that variable rate mortgages usually have smaller penalties if you break them early, whereas a fixed rate mortgage can sometimes have bigger penalties, especially if you have a large loan amount. Now, there's no one size fits all answer here, and it can be difficult for anybody to decide which one is the best fit for them. It really depends on your own personal situation, your comfort level, and what your long-term plans are. A mortgage broker, my job as a mortgage broker is to help you walk through those options and help you find a path that fits best for you, not just for today, but that matches your long-term plan. But at the end of the day, the best mortgage is the one that's going to help you sleep well at night. When you're thinking about buying, it's so easy to get caught up on the emotional side of things. I used to be a realtor before I was a mortgage broker, so I've seen this and experienced it firsthand. And one thing that I've heard that really helps is using something called the out of 10 rule. So when you're looking at a place, ask yourself, out of 10, how much does this property actually fit my needs? And you're not allowed to go with 7. If it's 6 or lower, you move on. If it's an 8 or 9, you start thinking, well, if I paint it, if I make a couple small upgrades, does this become a 9 or a 10 for me? Because buying a home is a huge decision. It's not just financial, it's lifestyle as well. And why settle for something that's just good enough? You want something that's actually going to move you forward, both in your life as well as your finances. Besides your down payment, you'll also need to plan for closing costs. These are the extra costs that come up when you actually take ownership of your home. And here's what closing costs usually cover. Things like legal. This is to handle the paperwork and the transfer of the title into your name. You also have property transfer tax based on the purchase price of your home. Home inspection. If you get a home inspection before you buy, and you should, that's usually a couple $100 out of pocket. But on average, you should account for anywhere between 1.5% to 2% of your purchase price just for closing costs. And I know it's not the most exciting part of buying a home, but the planning for it is going to save you headaches down the road. I know that this is a lot of information, but buying your first home doesn't have to be overwhelming. What makes the difference is making sure that you are saving intelligently, you're investing intelligently, and you're planning, right? You don't have to choose between financially smart and buying your first place. You can absolutely and should do both. If you guys have questions, you know where to contact me. My links are in the whatever thing below. You guys can book a call with me, send me an email. I look forward to speaking with you.